Okay, so let's get into it. EBITDA, EBITDA. Let's go through each one of them. I'll let you carry us here, Martin.
Okay. Well, it literally stands for earnings, in other words, profitability before interest, taxes, depreciation, and amortization. So it's what your profit would be if you looked at your P&L and did not subtract interest, taxes, depreciation, and amortization. Okay. So you are adding those things back. So if you look at your profit and loss statement at the end of the year and you have $100,000 worth of depreciation, which is not unusual at all for a small company. And when you're calculating EBITDA, you would look at your profit and you would add $100,000 to it.
Mm-hmm.
And the question is why? Why do people worry about that? I'll say two things to start out with. EBITDA is one of two numbers that are, this is going to be simplified, right? But it's basically how it's done. EBITDA is one of two numbers that you multiply together to get the value of your company. Okay. So if you made $100,000 in the EBITDA in a year, and you look at the other factor, which is the multiple, it's how much the market will pay you. And let's say that's 4. So 4 times 100,000, your business is valued at $400,000. Okay. So the question goes back then to why earnings before interest, taxes, depreciation, and amortization. The reason I believe is that the financial market is trying to value the company independent of its current owner. Okay. So your company made a certain amount of money, but you had to deduct a bunch of interest. And that's because you don't have any money to put into business. Maybe you do, but you borrowed money. It was a decision or a necessity depending on you, not on the company, right? So they add that back. Taxes. Many of our listeners are sub S corporations and LLCs, and there are no taxes at their company level. I mean, they're property tax and sales tax, but this is income taxes. So there's nothing to add back. But if you are a corporation and your corporation pays taxes, you add those back, and pretty much for the same reason. Taxes depend much on your choices as an owner.
And over the long term, the government and policies.
And it's just not going to be it's kind of independent of the company. The company made that money. Now it's got to pay taxes, and so might the new owner, but we're adding it back to keep it square, right?
Yeah.
So interest, taxes, depreciation. We're going to trust that our listeners know what depreciation is. It's how much you write down. So you buy a truck that costs $75,000. In the first year, you write off $50,000.
Yeah.
You expense it. And that goes against your P&L and it reduces your taxes. And oh boy, woohoo. But it reduces your earnings by $50,000. But that depreciation is a non-cash expense. It's a bookkeeping entry. And depreciation, whatever you buy, you're building long-term assets like buildings or trucks or vehicles or whatever you buy, does depreciate over time, right? A building much more slowly than your truck. So depreciation is a real legit thing. But the way depreciation is done, it's largely tax law, right? Everybody listening to us has done Section 179 or whatever it is, where you're going to buy a bunch of stuff and to write it all off this year. Well, it didn't really depreciate to zero in a year. That was a tax decision. So although depreciation is real, they add it back. Okay. And the last one is amortization. Amortization is depreciation for non-tangible assets. So if you bought a franchise from somebody and you have a lawn mowing franchise, you paid $100,000 to get it. You don't get to write $100,000 off. You have to depreciate that. So amortization is depreciation for non-tangible assets.